Now let's continue. 100% acquisition and consideration is one of common business combination cases. Okay, what is the difference between the merger and acquisition? Merger is A plus B is equal to A or like C or F, whatever. There's a new company or existing company combining, included in the A company, existing company. But the acquisition is totally A plus B is equal to A plus B. So the the acquisition 100% acquisition case, the P company is now is controlling S company by paying the cash consideration, and the P company has a responsibility to present consolidated financial statements, including this S company every end of the year. But you have to remember that S company is still existing. S company is still presenting their own financial statement separately. But the P company should make consolidated financial statement. Okay, so we are going to practice how they create consolidated financial statement in 100% acquisition case. Okay, so the same case, at the acquisition, pay the cash and investment increase. Now, we have a different procedure comparing this merger case. Merger cases, we include all the assets from the S company, but here, this is not the inclusion or combination of merger cases, which is A plus B is equal to A. But this case is A plus B is equal to A plus B, so it is investment. It is investment the accounting. So at the acquisition, P company should the record what? Right, this investment. So we put investment account is long term. It's a long term the asset account. Investment in S company 100%. 100%. How much was that? Right. The total consideration $130,000. Even though 100%, if the S company is still existing, then should be included as the investment in S. Okay. Then cash. Oops. Is cash. Is that cash? $130,000. Now let's start from this. At the end of the year, consolidated adjustment as if merger. Now, unlike this procedure of journal entry at merger, the company does not record all the fair value of net asset here, but they just use now the difference in asset, which is the fair value of asset minus book value of asset, and this book value of equity. Why? Why do we use the book value of equity rather than the fair value of equity? Yes, because here we go. We are not getting rid of this S company's total asset and liability. As you can see that, do you see any the S company's total asset or working the asset or liability or equity here? No. In the merger case, we don't, because we include total asset, the fair value of total asset and liability. So we don't have to put this the equity or the asset in this working sheet. But here, we will just make the P plus S. So we have all this the S companies the balance sheet, and then we'll adjust only the differences. Okay, but we'll get the same result as if the merger, 100% merger cases. Okay, so let's go here at the end of the year or at the acquisition. If the acquisition is the same as this December 31st, at the year end, consolidate adjustment as if merger. How do you get it? Okay, now book value of equity plus difference in asset. So book value of common stock. Now the book value of the S companies additional paid in capital. We'll remove this the total equity because it's not automatically extinguished in the consolidation process. Then book value of retained earning. I think we got all this book value from, there we go. Then I collected this value, okay? Let me just this, and then let's drag. Okay, and then what else? Now we put the differences. Now, what is the difference? As you remember, inventory differences. How much was the inventory differences? Inventory asset is greater than, the fair value is greater than the book value. So 1,000. So if the book value is greater than this fair value, we put this inventory here on the debit side, on the credit side, sorry, credit side. But here the fair value is greater than the book value. So we increased here on the asset side, okay? And then PP&E, also the franchise, that is the differences. I just collect these differences from this balance sheet of P&S company. So difference between book value and the fair value of this asset. Now I collected everything. Okay, so as you remember, this is the book value of the net asset. Book value of equity is the book value of net asset, right? Book value again, the book value of equity is equal to the book value of the asset, but we include this, the differences, inventory, PP&E, the franchise in asset. The sum of this is what? Sum of this is what? What is this sum? Right, that is the fair value. That is the fair value of net asset. Okay, that is the fair value of net asset. Okay, book value of equity, the fair value of asset minus the book value of asset, that is the differences. That is the fair value of net asset. Okay, you have to remember this. And then what else? Here we should remove investment in S. Why? Because once the P company controls S company 100%, this investment is no longer investment account on the consolidated financial statement. The company is now controlling 100%. There's no investment at all. Okay, so consolidated means we combine these two companies in one financial statement, so that this P company shows total power of using asset and the total obligations and the equity value, including everything. That's why when you see this, the financial statement in 10K, you see all the balance sheet and income statements, blah, blah, blah. It shows the consolidated balance sheet. Consolidated balance sheet. Example, that is consolidated. Apple statements of comprehensive income, statement operations, all are consolidated. Consolidated. That means include all the subsidiaries. Okay. And then, as you can see, that investment amount should be reciprocally the removed. Then what is this? That is the consideration. That is net value, net of the fair value of net asset. So goodwill is created. is created. How? Now simple. 130,000 minus. Now let's sum up this net book value. Net book value. The fair value of net asset. Fair value of net asset. Again, the book value of equity is equal to the book value of net asset. If we add the difference in asset, then the total of this book value of equity and the differences are fair value of net asset. Okay, so we got the difference, 12,000. Then we'll see the same result as the merger cases. Okay, then let's put this journal entry into the working sheet. Now we want to combine these two companies. It's not a merger. That's why we are working this procedure on the working sheet. Okay, only the work. We do not directly revise the financial statement of P company or S company directly. Even we do not touch S company at all. Never touch this S company, but we are adjusting P company only by adding this information, S company's information. Okay, so debit adjustment. Where do you see the debit adjustment? Okay, there you go. The cash $130,000 cash out on credit. Okay, and then what else? Investment in S. Where is the investment in S? There you go. Investment in S increased $130,000. The company they acquired this S company. And then what else? Okay, here you go. The inventory increased only by the difference. Okay, only by the difference. I'm collecting all the differences, and then goodwill increased 12,000. Now, what else? There you go. Investment in the consolidation adjustment procedure, it should be removed. As I mentioned earlier, $130,000 investment is no longer investment account on the consolidated financial statement. They have to show 100% merger, as if merger. Okay, because their company, they control 100% of the company, the S company. Then I believe we collect all the asset account. And then liability, we don't have to adjust any liability because we'll combine this S company manually. Okay, manually. Again, the reason why we didn't put the S company here is that is the 100% merger case. We assume the total liability, we assume the total asset as it is, as the merger is. But here, we do not put all the S company into the adjustment case because S company still exists. Okay. Here, there's no adjustment on the liability, and we have to now remove this book value of equity. Why? Again, why do we have to remove manually? It's not automatically removed because it's not a merger case. This is the consolidation process. That's why we have to manually remove this equity. Okay, but anyway, we will manually combine this total asset and total liability, not in this adjustment, but manually combine. Okay, so how do we get it? Asset plus. Do we have the debit adjustments? No. And then minus credit for the asset. So 148. Do you see? We have the same result. Okay, and then I'm going to drag down, which is the same cases. So 148 and 43 and 40, 237 and 3,000 and 12,000 And then that is the sum of this total asset. Now should be same as total asset in merger cases, because the effect is the same. 100% acquisition, 100% merger has the same total asset, but the combination process, consolidation process is different between merger and acquisition cases. Okay, so let me just double check. Okay, then we don't have any liability, so we just combine these two. Combine these two. Okay, and then capital asset, a capital stock, we combine these two. The debit, the equity account on the debit means minus, so we put minus, but here plus. Okay, we don't have any credit, then got it. The total, the sum of this new combination between P and S is $163,000. Then let's just double check. Okay, so the sum of this, the total liability and equity should be the same as total asset. So let's take a look at this too. We have the same result anyway. As I explained several times, the result 100% acquisition and 100% merger should be the same, right? Should be the same result, but the process is different. Because the in acquisition case, we manually combine this S company because S company still exists, is still running their operation. But here we don't have S company because S company is distinguished. Okay. Now for the case 3 and 4, the 90% acquisition, now you have to consider some other account, which is, right, non-controlling interest, which is 10% case. The next video clip. See you in the next video clip. Bye bye.